Test. All right. Let's look at hypercharge networks. All right. Let me move my screen around here. Hypercharge networks, ticker HCNWF. Let's start off by saying that this is a penny stock. It trades on the OTC Pink Sheet, and from what I have listened to, watched, researched, a lot of people that have been on the Wall Streets that have worked with the hedge funds, the penny stocks OTC market is one of the most heavily manipulated markets in the stock exchange in the US. And I presume it's because it takes very little money to move things. So what you'll get often, as with most stocks, but definitely in the penny stock market, is you'll get some pumpers, is what they're called. They'll go out there and hype up the stock, and this one's different in that it's a new company. I think they just came onto the market in January of this year, and it's a sector that is definitely not saturated, but the EV charging sector is a difficult market to break into and to be profitable in, unless you have come up with a new invention or have worked a lot of deals with suppliers or with either consumers or maybe charging a fleet of vehicles for a particular company. And the reason I say that is because Tesla has the majority market share for these types of for this particular sector. And even if you created a company that could charge a Tesla, because it would be a very simple adapter that you would use to plug in your Tesla, it would be pretty easy for Tesla to say, or to provide an update, a software update to their electric vehicles that would either prevent you from charging it using a third-party alternative, or they could pop up a warning that says your warranty is violated if you continue to use a third party, and that would register in their system that you did use a third party, and then your warranty would be invalidated. So I don't see them taking any kind of market share away from Tesla. In addition to that, Tesla and through the Biden administration have agreed to open up Tesla chargers to various different vehicles out there. So that gives them even more market share. And so I didn't see anything. Let's take a look here to do a little bit further research here. I'll come back to the earnings in a minute, but I'm looking at just the overall fundamentals of the business. I've tried to look at a lot of different areas that we'll come back to in just a second, but for now I want to take a look at the actual websites. Hypercharge, and I believe this is a Canadian company. Yeah, British Columbia. So you have to ask yourself, well, what is the market for them in the United States? And that's what I would be curious to know. We can take a look at an investor presentation, and let's see what they note in here. But this right here would be something to go through and really see what's their market share. Share of zero submissions by segment. Okay. Yeah, definitely the business transportation vehicles are going to be definitely needed, especially the trucks. But again, it goes back to who's the manufacturer of that electric vehicle. EV charger installed base, infrastructure. Okay, so I would not look at forecast at all. Those numbers, any kind of forecast with any company, Even FedEx, one of the largest shipping companies in the world, has kind of fudged their numbers when they report their earnings. And when I say fudged, I mean what they have done is they've given a range, and other companies, your blue chip Fortune 500 companies have done the same thing. When they report earnings, because we just started earnings season, I think this week, um, they've given a range on what their earnings per share is. And so, as far as I can remember, in the last 3 years that I've been following earnings, no company, the companies that do that are the questionable companies, the ones that aren't going to be around for very long. Not to say that the blue chip companies aren't going to be around, but what they're doing is that you've got an analyst rating, an analyst expectation on what their earnings and revenue is going to be. Well, if they give a range, even a dollar range EPS, I think FedEx did it, and other companies are following. They're saying that, well, we estimate that our earnings per share is between $3 and $4. Well, if the analyst comes back and says, well, if we're projecting about 350 or 375, and in reality their earnings was actually 310, 301, whatever, then they're gonna take a massive loss on their earnings per share, because they're going to come in under what the consensus was for revenue and for earnings per share. So, and I'm bringing that up because over at least the next year, companies are going to dramatically pull back on their estimates. And right now there's an attempt in the markets to prevent the bottom from falling out. Outside of the banking industry, Wall Street, who holds a good chunk of people's pension funds for various companies and millions of employees, the market, when the market loses money, then so do the people get upset because their 401ks are going down the drain, and then they come back to eventually make it back to whoever the fund is that maintains their portfolio, that's supposed to grow that fund, and end up coming back with a loss. So banks are in really bad shape right now. They took a lot of the money that their account holders had given them, and they invested it in really bad investments and bought bonds at very low interest rates. So we're going to start to see that kind of snowball and get worse over the next 6 months. And any other small business out there who is relying on capital from funding from their bank, that's going to dry up, and they're not going to get any more of it. So that's the reason why I ask, what is their overall picture of where they're at now, not so much by what they're forecasted to. So, and I noticed here it says government funding for electrification. That's great, but how much is going towards these guys? You apply for a grant from the government based upon your company and your company's ability to get a piece of that is not easy. You have to kiss a lot of asses in order to just to get your foot in the door with any kind of government grants. So, and the reason I say is because all this is just fluff. This isn't telling you anything about the company at all. It just tells you what's available out there. EV adoption should be frictionless. So this is one of their chargers, and right off the bat, I would question, okay, so connect, charge, change, that's great, but where does it tell you what it's compatible with? Are all EV chargers the same? Ford, GM, Tesla, etc. Every application, I'm sure it's fair for them. All right, so who I want to see here? Let's see who these are. I don't recognize any of these names. And director. All right, so independent director, investor strategic advisor. Okay, sold, delivered, parts sold, ports delivered, revenue. So they're selling across other parts of the world. I'd want to know who their customer base is. Who do they sell to? currently in revenue, so it's pursuing 13 million qualified opportunities. This means nothing. It just means that what you're trying to get business out there, and I get that. Growth trajectory. They did do a lot of revenue in 1 year, and I don't want forward-looking information. You want what did they actually do? So is this part here forward-looking? Because they haven't reported earnings for 2023. That would be the next big thing that I'd be looking for. When do they report earnings next? Because let's see here, it doesn't say when they report their next earnings. So that would be, before I decided to jump in this company long term, I'd want to see what their next earnings is. Expand in Canada, work with partners for U.S. expansion. Okay, so here's something else I saw it is a big concern. So there's going to be a dilution of shares coming up whenever they want to, and I'll get to that in a minute. Right now, they have 61 million shares that are owned by employees, other financial institutions. So what happens behind the scenes when what they'll do is when a company goes public, they'll get plenty of investors and hedge funds, big money to bring their prospectus to the market and register with the Securities Administration and assign a certain number of shares. And in return for those shares, the hedge fund will take those shares, and behind the scenes they'll sell those shares when the stock price goes up, and they'll buy those shares when the stock price goes down. And the reason for that is they're able to control the volatility of the market. So let's say some negative news comes out and this stock reached a high of 220. There was quite a bit of selling that went on up here, even though it closed above its previous high. There was a ton of people that sold and shorted the stock. So if the stock price drops down to a certain level, if it drops below $1, then that hedge fund will come in and they'll buy up more shares, and that props up that stock price above, so that let's say someone who has 1 million shares out there all of a sudden wants to dump all their shares onto the market for whatever reason, then they will come in and buy it up. And so over the years, you've seen Tesla get heavily shorted, heavily sold off. Elon Musk has created a lot of political blowback for the different things that he's done, and I've seen the stock price suffer because of that. Not just because of retail investors, but because hedge funds have pulled out of that company for various reasons, of course. But let's move on here. I want to show you something else here before we dig into the specifics of the stock price. Trusted partners here. So Target, Park, Sheraton. So these are all Canadian companies. Ramana. Okay, so the hotels, what they've done is they've installed these EV chargers at certain hotels. I'm not sure what that is. Target Park, Oshawa Power. Okay, so they're in the market. I'd like to know how many market expansion. I'd like to know how many EV chargers they have installed right now that they're collecting a revenue on. Yeah. All right. So that tells us a little bit about the company. Here's what I want to. Here's another positive that I saw in here, that they made 1.2 million in revenue. That's great. And they ended up with 4.1 million cash on hand. That's very good. So they have a strong. They're kicking off very, very strong. So I'd be very curious to know where a lot of that 4 million in cash comes from, because is that just from loans that they've received, that they've gone out and borrowed money on? That's where reading the where is it at here? Financial data. So this is where reading these numbers will come in handy. Here's where their 4 million in cash is. But they also they've got some liabilities here. What is it? Saw it up here. Net comprehensive losses, not a big deal, not too big of a deal. Deficit. What year was this? This is December 31st. So this is their unaudited numbers, and here's their audited numbers coming out of the previous quarter. So there's pretty big difference just here in their total assets, liabilities, and equity. So they were able to reduce their liabilities, but also their equity as well. So here's total liabilities. So their liabilities have increased, and so I'd be curious to know what how much in loans they have. I don't have time to go through here and break this down, but that would be something to look into. How much money have they borrowed? All right, so that's that. Now the other thing that I've noticed, let's take a look at the stock price here. Oh, I'm sorry. Let me go back here to the. I looked this up on the SEC filings. So there's only one. This is the only document that's filed with the SEC right now, and this is the concerning document, because what this is an offering of securities. This is the form that they file whenever they're going to issue more shares and dilute the stock price. And with these type of penny stocks and OTC stocks, what I usually see is there is a pump. There is an advertisement out there in the social media community and in the stock trade community of, hey, look at this company here. They got a great, good balance sheet. They got 4 million in cash. They're going to cherry pick all the great things about this company in order to promote it online. And shortly after, when the stock price goes up, 99% of the time, they'll come out with an offering. Because what they'll likely do, and let's break this down a little bit here. When was this filed? This was filed October 14th of 2021. Okay, so before the company even hit the market, they've already have an offering sitting on the table. Now, what do we know about this offering? We know that the industry is electric utilities. They asked them, what size of an offering are they going to do? Well, they didn't want to disclose that. Now, that very well could be because they didn't know. This was filed, long before what it appears they started trading on the market, because let's see, because this is the U.S. Securities Exchange, so I'm kind of confused as to, it was filed on October 21st. They didn't come to market until January of this year, so that was filed a long time ago. Now that makes me question, did they file that with the SEC? Did they file that with the Canadian version of the SEC, and then this was filed in the US before they decided to bring the company to market, an IPO? I don't know. Either way, it's still there, and I'd be curious to find out how many shares they started out with, and if they have used any of their dilution capabilities since they've been trading on the US market. So what do we got here? Offering and sales amount. I need to look at that more. Offering and sales amount. It's going to be an equity offering, which means that it'll be the shares and dilution. Okay, so new notice, date of first sale. Okay. You know what? Does the issuer intend this offering to last more than 1 year? Maybe this is expired. Yeah, this would need some more investigation. Maybe they already did a dilution. This is the only thing that's filed with the SEC, and so it's kind of, I'm not sure what to make of it. All right, so let's take a look at some technical analysis here. You can see obviously over the last week or two, the volume has started to pick up. And what I like to do is I like to go on to Twitter, different social media platforms. I use Webull here because it's an easy way to get kind of a pulse on what people are talking about. This stock, let's see how far back it goes. Let's see when people really started talking about it. Because you cannot trade this stock on Webull. You have to go to TD Ameritrade or another broker that has the ability to trade OTC. And so February of this year is when they started talking about it. Government's businesses being placed EV charging industry. So this could easily be someone pumping up the stock back in February. None of this, unless breaking news comes out and it's like, the company signed a partnership with Walmart. That'll make the stock, rocket up. But what has to happen months and weeks before the stock price starts to go up is that you start peppering the social media waves out there. Here's look at this company. I think this might be a great investment. Blah blah blah, which is a lot of times how retail traders come across information because it's spread throughout social media. Well, the companies pay marketing companies to market their company and to push or to, hey, we want to let you know about this new company that's breaking into the EV charging market. That's great, but there are other companies that are already in the EV charging market, Tesla being one of the leaders. You've got another one called EVGO, and they make tools and batteries. And you can see the volatility in their stock, but it's still holding up pretty good. I remember when this was down to $3. Then you've got a very well-known one, ChargePoint. ChargePoint has government contracts, and let's see what their revenue is, financials. Cash from financing. Net income. They're still losing money. They're not losing as much as they used to, but they're still losing money. And this is what's the market cap here? $2.5 billion market cap, and what are they trading at? Profit to earnings forecasted down 18. Earnings per share. So they're trading a little bit under what their earnings per share is, but when you've got when you've got major negative income in the millions, you're not gonna, a lot of people aren't gonna invest in your company. So let's take a look at. There's another called Blink. Is a very common, is a very well-known one. They're still operating a net income loss of -28, so that's not as bad, and their stocks are around this, a little bit less than the same price. So you can kind of get an idea, see, from other charging companies that have been in the business for a while in other parts of the world. You can kind of get an idea of where they're at now, not where they used to be. Got to remember that these companies, it's going to be many years before they ever get back to $66 a share. That was at the top of the COVID. When everybody got their COVID checks, they'd invested into the stock market, and everybody had all this money. And in addition to that, the Federal Reserve was pumping up stocks left and right to try to prop up the market to keep it from collapsing. But right at the turn of the January 1st, 2022, where is it at? Yeah, this one started to come down a lot earlier. But right at the beginning of No, it's 2021. That's what it was. Yeah, we peaked. We peaked January 2021, and then we started to slowly come down. What was the other one? CHPT. Yeah. So in technical analysis, just looking at the trend lines to try to predict where a stock is going. So let's go back to ours. On the daily chart, you can see here there are gaps. Whenever in pre-market, whenever a stock goes up and does not pull back during the trading day, it leaves a gap, and there are 1, 2, 3 gaps. In the natural course of a price action, the way a stock moves up and down, you will typically, stocks tend to want to come back and close those gaps. So that's something that has to be, you have to keep in mind and anticipate that at some point there's going to be a pullback. So with that being said, let's take a look at the 1 hour chart. So you can see, I see 2 major events right here. See the stock started going up, and then massive sell-off right here. Now, when I say sell-off, there's 2 things happening within these 2 hours and with this 1 hour. Number one, the stock went up. It looks like, yeah, let's do that one right there. Stock went up. People took their profits and got out. They made money. They got out. And in addition to that, short sellers, people who short the stock, are also coming in and pushing the price down when they short it, expecting that the price is going to go down. It's basically just a reversal of buying when the stock goes up. You short when you think the stock's going to go down. And so that's what's happened here. So let's take a look at that in a little bit more detail. I have lines here. This is the 1,000-day moving average. This is the 200-day moving average. These are some of the most commonly used lines and averages in stock charting in technical analysis, because you'll get traders who will literally buy right off of that 200-day. This kind of got close to it, but you see it didn't close that gap. It tried to close that gap, but didn't do it quite. Did not exactly do it. The other line I have here is called the VWAP, volume weighted average price, and this is an average of, it's a correlation between the volume, the amount of volume, and the price. So just to stick on a 30,000 foot level on that explanation, we'll just leave it there. But traders also trade off of that VWAP. So if it starts to drop below, they'll start to buy it up. This is on a 5-minute chart. And because this is a new stock, you really don't have a history of what levels, support and resistance levels, does it reach before it's going to reverse and go the other direction. So what I've started to draw here, this is a clear support level. When you get a moving average that coincides with a support level, you get what's called a confluence of data. And when you have multiple confluences of data at a certain point on a chart, that is a heavy support or resistance level. So right here we got to the top here and pulled back hard, sold off. But you can also see right here that this also, you also had an attempt to break through the high, the all-time high at this point. It came back, bounced off the 9-day moving average, this is the 9-day in yellow, and tried a second time. Couldn't break through, so it pulled back. And so it just kind of slow grind until eventually you had a lot of volume coming in right in here. These bars right down here is the volume. Can't really tell how much volume here, but you can see where buyers came in and the price shot up, broke through that level. And it continued higher to the next set, to the next line. And what you'll find is that the traders like to trade, they'll trade in, they'll buy and sell based on support and resistance levels, but if they don't have strong support and resistance levels in between certain price ranges, they will use the 25 cents, 50 cents, 75 cents, $1, and then they'll use 10, 20, 30, 40. So right here, where's the dollar at? Right there, just that dollar right there. Bounced off support from the dollar and continued upwards. And it continued all the way up till it reached almost 140, right there, 140. Hit that resistance level and pulled back. Tried it again. So we can definitively put a line across here. You don't want to put too many lines, but you want to get a foundation for if this price retraces back to a lower level, what point are traders going to come in and buy up the stock? That's how you predict the future, is what you're doing in essence. So let's see here, 5-minute chart. So now we have an all-time high right here. You'll start to see, I like to draw a rectangle here. And let me just briefly say, right now the entire market is trading off of technical analysis, support and resistance levels. The market is still highly overvalued. There's no way that most stocks, especially Apple, should be trading at what it's trading at now. So there is a massive rug pull coming. It's hard to say where that's going to be at. So I see right in here. I'm just going to kind of draw this zone, this area. Let's change this to a lighter color. This is what you're going to call a supply level. There is trapped supply in this case. There are people who did not sell up here, did not get out. So when the price comes back up to this level, you're going to start to see people taking profits or getting out of their trade, trying to break even or take whatever profits they had. Because you get a lot of people who FOMO and miss out on these pushes, and you'll see a lot of traders come in right in here, and especially traders come in and buy the high. I've done it before many times. So what you want is a pullback. Ideally, you want to see this price pull back to this 200 moving average. That's very, very important. And you can watch it. Yeah, you can when the price does pull back, it's either going to hold that price, or it's going to break through and push lower. And for this stock, it's going to be very, very volatile because of the float size right here. The free float of any stock tells you how many shares are floating around out there that are freely available for retail, the average person to purchase those shares. And the reason that number is important, because the lower that number is, the faster up or down that stock will go. It doesn't take many shares to buy to make this stock go up. It also doesn't take that many shares to make it go down either. And I'm going to show you the best example here. So the free float of this stock is $53. Berkshire Hathaway is 1. The Oracle of Omaha knew what he was doing when his company came in here and created how many shares? I got earnings coming up too. So because everyone has bought into Berkshire Hathaway for years and years, and that price has just gone up steadily for quite some time. But the reason that it's gone up so much, Berkshire shares are just bought and held. People's grandchildren have been handed down Berkshire stock since 1980. And it's had its fluctuations as well. 2020, COVID, it dropped just like everything else did. But my God, what a time to get in the 250 plus thousand and double your money in a short period of time. So that's why the float's important. A lot of your short sellers trade low float stocks. They love it. It's an easy way to make money if you like hammering down stocks. It's kind of a way of life. If people are into that, I personally am not, so I don't trade that way. So with that being said, uh, there's 2 points in time where we see. Let's see, what day was this? April 4th. Okay, April 4th and April 6th. So over a 2-day period, you had a massive amount of selling come in here. Look at this one candlestick in 5 minutes. In 5 minutes, it went from 220 to 150. That's almost a 40% drop in how many minutes? Yeah, it dropped. So it dropped more than it should have, and I can't remember what the percentage is, but whenever stocks drop really fast in a short period of time, it will trigger a halt. And that halt is the system, the trading system at the SEC or wherever it's maintained. It stops trading because the previous financial crisis and the stock market dropping it tries to prevent that. So what I did is I went in here and I wanted to take a look at how many, let's go here to social media real quick. So what I did, Twitter is a fantastic research tool. I typed in the $, which indicates that it's a stock ticker, and I typed in the ticker name. And I went through here and I was looking at different people's, what they were saying. You can see the people that are kind of pumping up the stock, and then the regular traders who are trading it. And so when you get down far enough, you'll come across traders like this. So you can tell that he took a short position. All these red ticks are sales and the greens are buys. So what he did, and many other traders doing the exact same thing, is when this thing shot up, they sold. They entered a short position. Short, 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 short. And if he made, you can see where, well, I'll skip that. He made about 7,000 on this. Okay, most of his money was made in these moves here. And what short traders have to do is they have to find shares that are on loan out there through their broker in order to short the stock. And so I wanted to find out how many shares are out there available to short, at any given time. iBorrowDesk kind of has some information on it, but it fluctuates so much even throughout the day that's really hard to tell. But this gives you an idea. On the 4th, these are shares available. So with Robinhood and a lot of your free brokers, you can option to loan out your shares. They'll pay you a very, very tiny, small percentage to loan out those shares. But if you loan those out, then other traders for other brokers can take those shares and use them to short a stock. And that's what they did here. Starting on the 5th, 9 o'clock. I take that back. So what happened here was more people started buying in and providing. More people started buying in. I guess it's probably not on Robinhood. It could be through TD Ameritrade or some other brokers. But the more people that bought this stock to hold, the more shares that are available for short sellers to short. And so when that happens, the stock price will not go up as quickly as one would have hoped, because it didn't take long for people. Let's see, what was the 5th? When did the trading day start? Yep, so people were buying shares. The next day, the brokers, hey, we've got 50,000 shares that you can short if you've got this. And what will happen is short sellers will start accumulating those shares. They can reserve those shares for a small fee. That's where this fee right here, this interest fee. So short sellers can say, I want 20,000 shares. Loan them to me to short as I will, as I see fit. And the broker says, okay, well, we're going to loan it to you at 18%. So every month, they hold on to those shares, they're getting charged an 18% interest rate. So they hold on to them, and they wait for that just right moment. Maybe not the 5th, but then coming into the 6th, where they'll dump or they'll start creating their short position. Short. They might cover a few, short more, short more. And then when it gets up to here, that's what all the other traders do. The sharper the incline, the sharper the spike up, the higher the probability it's going to come right back down. And this doesn't really matter what stock you're talking about. This is pretty much anytime it goes straight up like that, it's going to come down just as fast because short sellers will attack it, and that's what they've done here. This one did it. Let's go back. Now people are talking about offering the private placement I was talking about earlier. But I encourage you to go through here and take a look at everything. There's a lot of stocks out there that are held down significantly because of short sellers. So to kind of put it all in a nutshell here, you're going to get more attention on this stock, especially on the OTC side. People start talking about how much money they made. Think about it this way. Let's say you bought in off this, let's get a little 5 minute. Let's say you bought in here at this dip. Perfect opportunity. Found out about the stock right at 85 cents. And you kept buying on the way up. And let's say you dollar cost average, you're up around $1.40 here now. Let's say you've got 1,000 shares. I know the idea is to hold on these types of stocks, but the likelihood of this company outlasting all the others when it's still a very new company and succeeding is extremely low. Just because of the pullback in people spending money on electric vehicles, the Federal Reserve has not paused interest rates. And when the Federal Reserve pauses interest rates, the market is going to tank. And that's because people are going to pull their money out of equity stocks and put it into bonds. Once the Federal Reserve pauses those interest rates, then they won't be able to get those bonds at a higher rate. So they're going to want to lock in that for sure higher percentage interest rate in the bond sector. And that's where you're going to see, and these are people with billions of dollars. To protect their money, they're going to pull it out of equities and put it into bonds. And there's several charts that have shown that every time the Federal Reserve pauses interest rates, we have almost a stock market crash. It's pretty crazy. And let me just show this chart here real quick. This is the daily chart, going back to 2000. Let's do the weekly. This is the 2008 financial crisis. We peaked, in 2007. Bear Stearns declares bankruptcy and goes out of business a few months later. Then the market goes up. Everything's fine. Everything's great, right? It was just that one time. No. Officially July 2008 started the recession over here. But Silvergate, what's it called? The Silicon Valley Bank, they've already said that was the equivalent of the Bear Stearns. And what are we doing right now? Going up. We're going up because we've got earnings seasons and everyone's anticipating a run up in stock equities. That's all about to change as we get through. So how many weeks is this? This was in March. Where did the recession start? March, April, May, June, the beginning of July. So how long did we have? March, April, May, June. So 3.5 months. How ironic that Silvergate was last month. Not Silvergate, excuse me. Silicon Valley Bank, and here we are up again, looking exactly like it. We're at what, April 7th. So here, this is the weekly chart. So we're right here on this red candle pulling back. I can't remember if we finished red or green for the week, but once we get through the majority, JP Morgan, your banks report next week. In fact, next week it kicks off earnings season. We're going to start to come down right after that. Right after the NVIDIAs and Facebook or Meta and Netflix is another one. Once they report, we're going to all start to come back down. And my plan is to buy once we get past the majority of the technology company reports. We're going to start to come back down. So something to note that from the first bank that went under in 2008, Bear Stearns, March, we reached a low exactly 1 year later. When did the bottom fall out? Bottom fell out October. So April, May, June, July, August, September, October, 7 months later from the first bank. So, and interest rates, what was the interest rates? I can't remember at the moment. I don't want to look that up just now, but it looks scarily similar to what's going on. Yeah, first bank bailout. And look here, when back when Paul Watson, I want to say his name was, he was I think the head of the SEC. They came out and said if we don't bail out the banks, the whole market and the world is going to come crashing down. That was October 3rd when they announced that information. The markets tanked and down, and you can see how these moving averages are important because we tried to get above it. We closed above it here, but we closed down that day, and it took a while to get above it. I forget what it was here. So the stimulus package. Oh, here's your quantitative easing. This is where the Federal Reserve stepped in and started their quantitative easing. They started injecting money into the market, buying up mortgage-backed securities, buying up bad assets, and here we are. And so for the last, how many years? 12, 13 years, we've been on a steady climb upwards. So eventually something had to break. We're in that period where things are breaking, and that's why they say this will be, one thing I forgot to tell you. The reason they say this one's going to be worse than this one, look how small this one is compared to this one. Let's close this out and hide these drawings. So we went from a high of 120, 125, 124 down to 53. That is over a 50% drop. That's back when the SPY, now can you imagine the Dow, the entire market, being 60% lower? If we're at 470 now, %of 470, 282. So we should be closer here, which is more in line with where we were before COVID. And think about how our economy was doing, how well it was doing back then. We were blowing and going. Well, we're entering a recession, and we've got more companies that are laying off more people. So when things were good, we were in the 280s, we should probably be closer to the 200s, if not lower. That is a massive, massive drop, and very scary to think about where we're likely headed. And that's if China does not invade Taiwan. That's if other countries, that was before we didn't have countries dropping the dollar, the petrodollar, and joining other countries in trading outside of the dollar, trading in their own currencies or in gold. So, with that being said, as far as any kind of investments, if I were buying, well, I am buying. I bought TLT bonds because as equity prices have gone up, people have pulled out of bonds, sold their bonds, and because equities were more profitable, Apple, Netflix, Apple, Meta, all those companies, but now they're coming back in here. You're starting to see a trend now. The trend is going to go up. Right now we're bouncing in a range here, but over the next few weeks, bonds are going to break out and go up, and that would be right on time with, let's go back to 2008. See here, people went into bonds. That October, and then it just took off. Now, I don't know why there was a big sell-off here at the end of the year. Could be because of taxes. They wanted to take the profits and get out. But you went from 70 to 90, $20. What's that? 20, almost a 30% increase. So I would not be in equities right now. If you trade equities, if you trade these stocks, buy when it hits the 200. Sell when it gets close to all-time high. Or sell half or 3/4, take your profits, get out. Let the rest ride. Be okay with selling, because the next time stocks have a big sell-off, this is going to sell off as well. Every day this will get sold off, because every day more and more shorts. The higher this gets, the more shorts will come in here and pile on and try to push it down. And the shorts, they hold on to their trades a long time too. They'll hold on to it for months until it comes all the way back down. So if this gets up to $3 and they put 10,000 shares at $3, they're going to hold it till it gets back down under $1. Now the good thing is about when they close out their shares, in order for them to exit their trade on the shorts, they have to buy back the stock. So that will cause it to go up. And that's the beauty about what's called a short squeeze. Once the shorts have got in here, and what happened here was shorts took short position, heavily shorted it got down here. They closed out their positions by buying it back, and that's why you saw this go back up, because shorts started closing their positions, and it's come back up. So it has to break through this area. I would not be interested in this stock until after 220. If it breaks through, you want to look for a retest. If it breaks through, because you don't want to get stuck with what's called a false breakout. And this is kind of like a false breakout, where it breaks through a level and gets slammed right back down. The market makers, the Wall Street, the heavy traders will come in here and buy this up, pushing it up, and then just sell it right off as traders come in thinking that this is breaking out. As this starts to push higher, those people that bought in down here will sell out up here, and that's what causes a false breakout. The sellers exit massive positions up here, and it just pushes it back down, and that's why you get what are called bag holders. They get stuck up here. That's what's happened up here. There are a lot of traders got stuck up here thinking that it was going to go higher, and they got sold out on. And so that's why I say this becomes trapped supply, because traders are trapped up here. So when it gets close to coming through here, a lot of traders will get out. They'll break even, maybe they'll get a tiny bit of profit, but they'll get out of that trade. And so it's hard for the price to push through these levels because of that. So something to keep in mind. Again, I'd wait for the pullback, buy in. This thing could easily go higher because of the 53 float. So what I would definitely pay attention to is if I bought into the stock anticipating something long term, you got to be worried about an offering coming out, diluting the stock. And if you own actual shares and they dilute the stock, what they'll do is like a 2 to a 1. You'll get more shares. No, I take that back. I don't think so. I think the stock just gets diluted because they're adding shares. Yeah. So you got to be careful about the dilution, and don't buy up here. I would wait for a nice pullback. There's still going to be hype. There's still going to be talk about it on social media. And the more hype you hear about it, you got to be careful because that very well could be that they need capital, they need money. Let's say a lot of companies that'll get a new contract with, they've got a $40 million contract to install and produce charging stations for a company, but they need capital to raise in order to make that happen. So that's the reason why these offerings are done so often, because a company will do an offering, get that equity back, and put that money towards investing into their charging stations. But just because a charging station is there does not mean it's always going to be there. There are a ton of, you're about to see a lot of companies, they're called zombie companies, that are about to go out of business or be acquired and absorbed, just like the banks did in 2008. So, all something to keep in mind.